Damien, can you with any conviction predict the trajectory of gas prices at this point?
It's an extremely volatile situation in Europe. And as Rachel laid out, right, there are still significant supply risks ahead. I mean, the market seems to think gas supply will persist, but one potential outcome of shifting payments to ruble would be to break those termed contracts. And as we now know, since last summer, Russia only sends term contracted gas to Europe. So there are still risks that we could get a much greater decline in European gas supply. And that's what the market is struggling to price, right? As of now, flows are sufficient that we will make it without a problem through next winter. But those risks of losing supply are significant. And the market is already pricing a 20 to 30 probability of that happening. So there is a risk premium. I think that can lead to even more volatility ahead.
Looking ahead to the next winter, as you say, is now critical, Damien. Europe needs to presumably keep the price of gas in Europe higher than the price of gas in Asia, because it looks like LNG is going to be the swing factor here in determining whether or not actually we have sufficient for the next cold snap.
Exactly, right. So when you think about the global gas market, really Europe is the short. And so European gas prices have to be above everywhere else to attract those spot LNG cargoes. Now that's working so far, right? We've seen US volumes redirected to Europe. We've seen Asia take less cargoes, send it to Europe. The issue, however, is there's only a finite amount of incremental LNG imports into Europe. And if you run that at capacity through the summer, you're just really displacing, a quarter to a third of Russian gas imports through LNG. So that's not sufficient, right? That doesn't achieve the goal of stopping to consume Russian gas by next winter. And that's the critical issue for Europe.
All right, Damien, so that's on the gas side. Let's talk about the oil side. The Biden administration announcing today it's going to tap the SPR in a major way, 1 million barrels a day for the next 6 months. Does that have any real impact on the market, or the desired impact at least?
That sale is notable by its size, right? If you look at the last two sales in November and earlier this year, they're quite small. Now we're talking equivalent to 1 million barrels per day of supply, so that's a bit less than what we're losing from Russia over 6 months. And the reason it helps now is this is really the point where we have the biggest hole, the biggest deficit. So it helps. However, the key is it remains a stock sale, right? It's a one-off sale. It is not a multi-year increase in production that would offset a multi-year decline in Russian volumes. So it really only helps in 2022. And in fact, when you map it, it actually means we need higher prices now in 2023, right? This SPR sale will have to be replenished. Yeah. And I end up 2022 with lower prices. So on the margin, more demand, less shale supply, I have a bigger hole in 2022.
Damien, what does this release also imply about expectations in Washington about what we're going to get from the Iran deal and what we're going to get from OPEC and OPEC Plus?
Yeah, I mean, it's difficult with all those moving parts, right? So we know OPEC Plus from this morning, they're sticking to their gradual increase in production. The SPR announcement, if anything, probably supports such a path as it's providing incremental barrels that don't really require OPEC to step up. Perhaps an SPR release now starting in May reflects a slower outcome on getting a potential Iranian deal through. So, at least it may suggest that this OPEC help will take longer to come. But again, as I stated, right, it just, even though it's a record large SPR release, it still doesn't resolve the deficit. Here's a simple way to think about it. Early March, before any disruption, the global deficit was 1.5 million barrels per day, right? So after the longest deficit on record, we are still at a 1.5 million barrels per day deficit. We're not even plugging that hole with the SPR. So, prices still have to be higher, and nothing has been resolved at this juncture.
All right, and Damien, we're just getting some breaking news that the UK is considering joining the US oil reserve release plan. So potentially other allies, other countries getting in on this as well. How do you factor Shale into this equation, which has been trying very hard to maintain capital discipline? How do you view the Shale patch?
Yeah, so on the coordination, there was headlines yesterday as well. I think there's a call on Friday morning to get other countries to participate. But really, the only one who has that big resource is the US for the SPR. Let's turn to shale now, right? So one would argue prices are higher than they were a month ago. So, there's elasticity, revenues will go up and production as a result can go up. But just look at price volatility over the last month, right? We've gone from extremes, right? 98 to 140 to 98. Volatility uncertainty is not conducive of spending $1 billion in capex. That's a very rational reluctance. And one way to think about it is, if you're to hedge your production for 23 today, it would actually cost you exactly the same as if you did it a month ago, right? So the increase in prices has been fully offset by the increase in uncertainty. And with the market pricing in a 25 to 30% risk of a recession next year, again, as a deployer of capital that will be sticky for several years, you can see the reluctance. So, we do expect shale to grow, right? Shale is already expected to grow. On the margin, we expect it to grow a bit more. But keep in mind that uncertainty is going to be a headwind. And second, U.S. shale is already operating at capacity in many sectors, whether it's sand, whether it's pressure pumping, and that's going to take time and higher revenues, hence sticky higher oil prices, to be able to grow. And that's, I think, going to be a key bottleneck for this sector this year.